I did, Ali.
Perfect, thank you. Okay, so we're gonna start. I'm gonna pass over the microphone to Lydia.
Yeah, we'll get started. Okay, well, good evening, everyone. Thank you for making it to this year's webinar on how to grow and invest your wealth. I'm Lydia, I'm one of Aleem's interns this year, and I'm really happy to be giving him a quick intro before we jump into today's agenda. So Aleem is the owner of Transform Financial and co-owner of MIRFP Financial Planning, a company that has been in financial services for over 25 years with over 1,000 professionals and business clients. Aleem has been a financial advisor for over a decade, working independently with over 40 companies, including all the major banks, mutual funds, and insurance companies in Canada. Aleem won the Distinguished Wealth Professional Canada Excellence Award in 2023 from over 16,000 financial advisors nationally. Aleem was one of the top financial advisors for Industrial Alliance, Empire Life, and Qualified Financial Services. Aleem has also been interviewed on CBC, CTV, City TV, Globe and Mail, Toronto Star, and Investment Executive. Aleem is also a top-rated professor in the BBA and MBA and executive education programs at the Schulich School of Business at York University, the Rotman School of Management at U of T, and the executive MBA at the University of Salzburg in Austria. Aleem was the youngest and first professor to win the largest teaching award in North America from over 200 faculty in his first year of teaching. He has been rated in the top 10 professors at the Schulich School of Business for 4 years in a row, from 2015 to 2019. Prior to teaching, Aleem spent over a decade in management at several global Fortune 100 companies, including Pfizer, American Express, Kraft, Novartis, and Tata. Aleem graduated on the Dean's List from both the HBA and MBA programs at the Richard Ivey School of Business. In his spare time, Aleem volunteers as a board member for the Gildas Club Toronto, an organization that helps people while living with cancer. He also volunteered as a board member for the Ivey Alumni Network in Toronto on the Board of Finance and Accounting Professionals Alliance Canada. He's a national director of marketing and communications for the World Partnership Walk and has helped the Aga Khan Foundation of Canada raise over $130 million through the Walk Towards Poverty Alleviation program in Asia and Africa. He also volunteers as a ski instructor with the Adult Disabled Downhill Skiing program on the weekends. And he's also a proud father to a 7-year-old daughter, Bella. Aleem, I'll pass it back to you.
Thank you very much, Lydia. Appreciate the intro, and thank you all for joining me. If I could ask you all to just mute your microphones, I'm going to go through the presentation and we'll leave the questions until the end. So the first thing I wanted to ask you is, what is really your greatest concern? Are you worried about running out of money, having enough money for retirement, worried about minimizing taxes, looking at maximizing charitable gifts, looking at passing on more wealth to your children or your family? And are you just overall concerned about what are your next steps? So in today's presentation, we're going to go through a few things really quickly. We're going to look at what happened in the markets and what we can look forward to for the future. We're going to go through some important investing principles on how to invest and grow your wealth. And then we'll talk about retirement and tax planning. So before I move on, I just want to make it clear that all of the content that I'm presenting is my own content, and I pulled it from different sources, but it is my own opinions, and they don't reflect the companies that I'm representing. It is my own personal perspective. I recommend that you all seek financial advice and speak to a financial advisor one-on-one, because the products that I'm recommending don't apply to everybody. But whether or not you use me or another advisor, the stats actually show that people who use a financial advisor actually retire up to 2.3 times more wealthier. And the reason being is because financial advisors give you personalized investment strategies for the long term. They help you stick to your goals. They give you guidance on major financial decisions. They help you, encourage you to have good financial habits and regular contributions. They find tax efficiencies for you to save not only on taxes, but also to generate more wealth and pass on more wealth to your family. And in times like today, where the markets are volatile, they support you and help you stay on track in times of volatility. So a little bit about my company. We focus on business owners and professionals, and we help them generate wealth through 3 main ideas: decreasing their taxes, strategically growing their wealth, retirement, and investments across generations, so the estate planning part of it, and then also making sure that they have enough cash flow and protection for their money. And how we're a little bit different is we provide a full financial plan. So we do everything from cash flow management. We look at risk management. So your life insurance, critical illness, disability, long-term care insurance, group benefits. We do the tax planning for you, both for your personal and business. And then we look at different investment vehicles to optimize your returns, both RRSPs, RESPs, non-registered TFSAs, RIFs, and annuities. And then we also work on estate planning to make sure that you pass on more wealth to the next generation. And the one big difference about us versus other advisors is we're completely independent. So we work with over 40 companies, all the major fund companies, all the major banks in Canada, and all of the major insurance companies. I didn't have enough room on this slide to put all 40 companies, but you can see some household names that you recognize in Canada. So now, if you look at what happened in the market and what we should look forward to, 2024 across the board was a wonderful year for equities. It was interesting because at the beginning of 2024, the market had projected a recession, and they had projected that interest rates would not go down, and therefore it would create a recession, and that actually didn't happen in most major markets. So in the US, the market went up in 23 by 23%, and went up in 24 by 36%. Globally, it went up in 23 by 20% and in 24 by 29%. Canada went up by 12% in 2023 and 22% in 2024. Emerging markets were up 7% in 23 and 17% in 24. And international equities, you can see, were up 15% in 23 and 13% in 2024. So across the board for the last 2 years, we've had significant growth. What I'd caution you to do is to look at 1-year returns, because markets go up and down in the short term. You have to look at long term. And you'll see that in the top chart, you'll see that Canadian equities, US equities, international equities, and emerging markets over the 1-year, 3-year, 5-year, and 10-year period all went up, except for emerging markets over the 3-year. And when you look at calendar year returns, you'll see the 2023 and 24 results were stellar, all green across the board. We had a really rough year in 2022 where markets were down across the board. But interestingly enough, in 2023, they came back more than they did in 2022, and that growth continued. And you'll see that over the 6-year period, there was only 1 year where the markets were down. So what did most investors do? Most investors actually panicked. In 2023, at the end of 2023, when people talked about a global recession, most people in Canada and the US moved. We had record inflows into cash, high interest savings, and GICs. So at the time, at the beginning of 2024, GICs were paying roughly 5% return. And if you take out tax, that's about 3.5% return net of taxes. But if you look at all of the markets across the board last year, they were all up significantly more than that 3.5%. So what I'd caution you to do is when people talk about in the face of volatility and risk, and especially right now when people are talking about tariffs and a market downturn, it's important to stay invested. And I'll explain to you why. When you look at investors' perceptions about Canadian stocks, this is from RBC Global Asset Management. You can see that in 2024, every sector except for consumer services was up. And when we look at the outlook and the forecast for earnings and price to equity ratios or price to earnings ratios, the growth forecasts across the board, both for Canada and the US in 2025 and 2026, is positive, and also all over the world. And part of that is because the fixed income or the interest rates are expected to continue to go down this year. So if you look at the US, they're at 4.5%, or expected to go down to 3.75%. In Canada, we're at 3.25%. We just had a drop 25 basis points last week, and it's expected to go down to 2.75. And you can see also in Europe, United Kingdom, Japan, across the board, except for Japan, every single market is expected to drop interest rates. And also, if you look at the long-term bond rates, you'll see those rates are also dropping as well. So why are equity markets expected to go up? We've had impressive gains in the last year, and markets have climbed to record highs. The strongest returns were mostly in the US by mega cap technology stocks, but it looks like over the summer and in Q1, we're going to actually diversify the returns, and international markets are expected to come back. They have been underperforming after Trump's election win, but given that his policies favor domestic growth, that could also be a little bit of a headwind. And we also look at strong returns in global equities. The key concern is that US equities may be overvalued. But we can't ignore the elephant in the room. Every day we hear different news from Trump, and every day he changes his mind and comes up with something new. These are just some of the headlines that you've seen. Trump signs a new trade deal with Canada and Mexico after negotiations, and then he stops the trade deal with his own negotiating tactics. And now he wants to renegotiate the trade deal with Mexico and Canada. And as recently as yesterday, he just changed his perception on tariffs. So why really is Trump doing this, and why is he so focused on tariffs? Part of the reason is because he's made promises to the US to improve the economy and to cut taxes. And if you look at taxes in the US, 49% of the federal revenue comes from taxes. So if he's going to cut taxes, he has to take money out from somewhere else to compensate. So why is he really focused on Canada? And if you look at the trade deficit that he keeps talking about between Canada and the US, our trade deficit in 2023 was only about $40 billion. To put in perspective, that's less than 5% of the US trade deficit. The EU has a trade deficit 3 times higher at 120 billion, and Mexico has a trade deficit 4 times higher of 160 billion. But more than anything, more than half of the trade deficit is with China. It's over 252 billion. So this whole focus on Canada is really short-lived. I think part of it is he's just trying to use it as a negotiation tactic. But he has declared that he's going to be putting um, tariffs on oil. So right now, the last we've heard is 10% tariffs on oil. Canada represents 60% of US crude oil imports, more than any other country. And a 10% tariff on oil will drive up prices not only for Canada, but also for the US. And so it's not very likely that these tariffs will continue for the long term. And also, as recently as yesterday, I had to add this slide in that he's declared there's going to be 25% tariffs on aluminum and steel effective March 1st. At least that's for now. The interesting thing is the US gets more than half of their aluminum and more than half of their steel from Canada. In 2018, Trump put a 25% tariff on steel and a 10% tariff on aluminum. Canadian exports to the US dropped immediately, and it did result in some layoffs and increase in unemployment. But a year later, the economy recovered when the tariffs were taken away. So we have to be very careful in worrying about the long-term impact, because it could very well be short-lived if the Canadians start having tariffs on goods to the US, it'll also cost the US and it'll also affect them. And the one thing to look at is it's really common for politicians not to fulfill every promise. If you look at Trump's track record in 2016, he only kept 23% of his promises, and 53% of those promises were broken. And the problem with most politicians is their ideas are short-lived, and the moment they get in power, they change their mind. And surprisingly enough, but Biden was exactly the same. He only kept 1/3 of his promises, and he broke about 1/3 of his promises. So his track record was a little bit better, but nonetheless, presidents do not keep their promises. And so things may change in the short term or the long term. So the key thing here is to focus on how you should invest and grow your money. And this is where the biggest opportunity lies. There are 6 principles of investing that I'm going to talk about now. The first one is to maximize your tax sheltered investments. The second one is to increase your diversification. The third one is about having time in the market versus trying to time the market. And then we'll talk about dollar cost averaging, so regular ongoing contributions as opposed to a lump sum at one time. And then we hear a lot of noise in the news and the media about the market's going to be going down, or there's going to be a recession, or, there's all of this stuff that is noise and people get really emotional. We hear about Bitcoin, we hear about Nvidia. And to be honest, if you invest based on your emotions, it's a losing proposition. The key thing is really to buy and hold over the long term. So, simple thing, why should you worry about retirement now? Imagine you have a twin and both of you are investors. If you invest $2,000 a year at a 10% rate of return for 10 years and you start at 25, and your twin invests exactly the same 2,000 a year at a 10% rate of return for 30 years and starts at 35. So they're investing a total of 60,000 and you're investing a total of 20,000. But you're starting at 25 and they're starting at 35. Who ends up with more at 65? Well, I think most of you will know this is a little bit of a trick question. Because you started earlier and you have compounding returns, you end up with almost double the amount of money investing the same amount with the same return. You only invest for 10 years and your twin invests for 30 years. But because they started 10 years later, they end up with less than just over half the amount of what you would have. So the key thing here is to start early and invest regularly as much as you possibly can. The second essential thing is to focus on tax sheltered investments. So whether you look at RRSPs, TFSAs, FHSAs, RESPs, registered investments will do better than non-registered investments because you have compounded growth that is tax-free. So take this example, if you invested $200 a month for 30 years with a 10% rate of return into an RSP or TFSA versus a non-registered account or a savings account with the same return and $200, you would end up with just literally like almost double with a registered plan versus a non-registered plan. So it's really important to take advantage of your registered investments. And then why we should diversify across geography. Most people in Canada have a majority of their investments in Canada. Canada, as a share of the world's economy, is less than 3%. Let me put it another way to you. 97% of the world's investments are outside of Canada. And as an example, if you look at the top 5 markets, you'll see in 2016, Canada was the best market. And you'll see just 4 years later in 2020, Canada was the worst market, right? So, and same thing with China. You can notice that there's years where it was in the top 5 and there's years where it's in the bottom 5. If you invest just in one economy in one area, such as the US or Canada, you're putting yourself in a lot of risk. It's also important to look at this by geography. And if you look at this chart, you'll see the best performers are at the top and the worst performers are at the bottom. It's really hard to see a consistent trend between any of these areas, right? So for example, if you took global equity in 2022, it was the 4th worst performer. It lost 11%. The following year, it was the 2nd best performer. And last year, it was the 3rd best performer. So it's important to diversify across geographies and across different asset allocations between bonds and equities as well. And then also by asset classes. So it's almost impossible to predict what class will generate the highest return in any given year. You can see from 2000 to 2022, the 10-year average return varied considerably between these different markets, between Canadian equity large cap, Canadian equity small cap, US equity large cap, US equity small cap, international equity, emerging markets, global real estate, Canadian fixed income, global fixed income, high yield fixed income, and a balanced portfolio. So the key thing here is it's impossible to predict what can happen. So it's important to diversify across asset classes. And the same holds true for investment styles. It's hard to know when a certain investment style will outperform. You can see that in 2023, growth was the best performer, but in 2022, growth was a worst performer. So if you had put all of your money into growth in 2022, you would have lost 29%. And if you kept it in growth the following year, you would get plus 29%. You would actually not end up at zero, because if you drop 30%, you need 43% return in the following year just to get back to zero. Okay, so it's really important to look at your downside protection as well and diversify by investment styles. And if we look at the last 24 years, you'll see that value was outperforming over the 10-year relative performance. Value outperformed from 2001 till 2011, and then we had a little bit of a flip, and then from 2013 till 2024, for the last 10 or 11 years, growth has outperformed. But you notice that over the last 20 years, it's varied considerably. So putting all your money in growth stocks like the Magnificent Seven or technology is a very high risk. Having a balance between value and growth is very important. And if you look at diversifying just by styles, if you put half your money in growth and half your money in value, you'll notice that the balanced portfolio did higher average return, had less volatility or less variance, and less downside. So in the worst 3 years, only down 15% versus growth, which was down 25, and value, which was down 17. And over the 5 years, it also did better. Okay, so the key thing here is to diversify by not only asset class, by geography, by investment style, by size of investment, and also value and growth. And here's the biggest problem. The average investor over the last 20 years only made about 3.6% return. Almost every equity class did better than the average investor. And the reason being is the average investor listens to the market and listens to the noise in the news, and they pull out when markets are good, and they put in when markets are bad, right? We invest based on emotions. We don't actually look at huge macro indicators. We don't have the knowledge to be able to time the market. And a lot of people just chase returns. You know, you hear, for example, crypto has been on fire. So a lot of people are investing in cryptocurrency or Coinbase or Nvidia, for example. Nvidia had a record high in 2023, but in 2024, it corrected. So if you began investing $400 a month in the US stock market in 1982, here's what you would have faced: 6 recessions, 5 bear markets, 41 federal rate hikes, the dot-com bubble, the Black Monday, 50%, more than 50% crashes, 12 US wars, the global pandemic, impeached presidents, the great financial crisis. And if you just kept your money there, you would have invested 192,000 and you'd have a total of over $4 million. So the key thing is not to react to what's happening in the news and what's happening in the market with all of the doom and gloom that we hear. It's important to stay invested. And this is where the best opportunity is. If you invest on an ongoing basis every month, you avoid the market fluctuations between it going up and down. And if you consistently put in $500 a month into the S&P 500 index, you can see the blue line, you would end up doing better. You'd end up at 5.1 million. You do even better than buying at the major bottoms, because it's almost impossible to predict when the market is going to go down or when it's going to go up. And if you bought at the major tops, so at the worst times, you would end up with 2.9 million. And if you didn't buy at all, you'd only end up with $500,000. So it's always better to invest and invest regularly on an ongoing basis. And the biggest challenge for most investors is when markets are good and things are going well, they end up investing more because they're very confident. There's enthusiasm. There's a lot of positivity when markets are up, right? And that's when most people invest, which is actually a bad time to invest. A good time to invest is where there's more opportunity for gain. When markets are down, when people are feeling a sense of urgency, when they feel like they're selling, the best time is to invest when markets are actually bad. So when we have corrections in the market, that's when you should be investing. But again, it's impossible to time the market. It's always better to have regular contributions. And the interesting thing is that if you had pulled your money out thinking that it's the best time or the market is up and you miss the best 30 days, your $10,000 investment over the last 20 years would only be at 10,900. Versus if you stayed fully invested for the last 20 years, you'd have more than 6 times more money than if you missed the best 30 days. Okay, and compared to that, if you missed the best 20 days, you'd only have 6,000 more. And if you missed the best 10 days, you'd have half or less than half than if you stayed fully invested. So when markets are bad, what people typically do is they pull their money out and they put it in cash and safety, and then you typically will miss the market upswing because it happens very closely. And what happens to most people is they put money in safe investments when markets are volatile. And if we take just a 2% rate of inflation, to put in perspective, 2 years ago, we were at an 8% rate of inflation. But at a 2% rate of inflation, $10,000 would be worth only $6,700 in 20 years. So if you're trying to be in safe investments, it's not going to give you enough money over the long term because of inflation. So I'm sure you guys have all seen the Super Bowl ads and the Questrade ads. They keep talking about retiring 30% wealthier by saving fees, and it's way more efficient than using an advisor or mutual funds. I would caution you from just taking that at face value. The key thing is, yes, fees are important, but it's important to not just look at fees. You have to look at the net returns after fees. So I'll give you an example. The Questrade growth portfolio, 100,000 invested from December 2021 to November 2024, you would have 127,000. If you put the same investment into a Fidelity all-in-one growth ETF, the fees are roughly 1% or 1.28%, you would end up with $143,000 net of fees. So roughly $16,000 more than the Questrade portfolio. Because if you look at the excess return, it actually does better net of fees. And the same for the balanced portfolio. If you put in 100,000, your Questrade balanced portfolio would be 122. The all-in-one balanced ETF with Fidelity would be about 130,000. And if you look at it over every time period, the Fidelity portfolios on the conservative portfolio, they outperform by 4.7 or 3.5% net of fees. On the balanced portfolio, they outperform by 6% and 4.5% net of fees. And on the growth portfolios, they outperform by almost 10% on the 1 year and over 6% 3 years. So over 3 years, you'd end up with 18% more money. So it's really important to look at your returns net of fees. And I'm going to show you some of the top performing Fidelity funds that I recommend. The reason why I like Fidelity is their largest fund manager in the world. This fund, the Contra Fund, is the largest mutual fund in the world. It's $300 billion. And there's 1,600 analysts who work for Fidelity around the world globally that are constantly monitoring and investing in this fund. If you look at from the time that this fund manager, Will Danoff, took over the fund in 1990, over the last 34 years, the fund has done an average of 14% return compared, and that's net of fees, compared to 11.2% for the S&P, the US index. So if you invested $10,000 in the US index, as of the end of the year, you would have had 379,000. If you invested the same 10,000 in this fund, as of the end of 2024, you would have had 874,000. So net of fees, you would have roughly $500,000 or $495,000 more investing in this fund than the index. And you'll notice that even net of fees, over every single period over the last 34 years, this fund has outperformed versus the index. And this fund is called Insights Class in Canada. It was launched in January 2017. It's exactly the same fund. And you can see that over the last 6 years, it's done an average return of 17.3%. The S&P 500 US index has done 15%. So net benefit of about $4,000 on a $10,000 investment. Some other options that I like, as we really don't know if growth or value are going to outperform, or large cap or small cap are going to outperform. This is a good diversification strategy. It's 50% large cap and 50% global small cap. It has 50% in growth and 50% in value. And when you look at the performance of this fund, it's outperformed the benchmark over the 1 year, the 3 year, the 5 year, and since inception. And it's had Morningstar first quartile rankings across the board. So you can see that it's done 28% over the 1 year, over 10% over the 3 year average, and over 14.4% over the 5 year, and since inception, 11.6%, outperforming the benchmark considerably. Another fund, if you're looking at growth, is the Fidelity Global Innovators class. This fund has won more Lipper Awards, which is an independent party, than any other fund. Mark Schmel has won 14 Lipper Fund Awards. It's the best performing global technology innovation fund in Canada. Last year it did 64%. The 3-year average was about 15%, and the 5-year average is about 26%. Since inception, it's done about 24%, and you can see that it's beaten anywhere between 98% to 100% of its peers. So across the board, it's outperformed against the benchmark and against its peers. And another area of opportunity is the Fidelity Global Small Cap Opportunities. So small caps are market cap of between 1 billion to 12 billion. This fund over the last 5 years has done considerably better, almost double the MSCI World Index. And the reason why there's good opportunity in small cap right now is their price to earnings ratio, what they're trading at, is significantly less than the US market. So if you're looking to diversify, this is a good option. You'll see that it's done 73% since 2019. And over the since it started, it's been about 15% average return, which is more than double the world index, MSCI World Small Cap Index. And if you're looking for a diversification strategy, the Global Equity Plus combines the top 4 Fidelity funds. So you have Global Innovators, Greater Canada, Canadian Large Cap, and the Global Value Short Long Fund. And you can see that over time, this diversification strategy actually outperforms the world index by about 5.4% on the 3 year, and it's beating about 98% of its peers over the 3 year. And the reason why it's good is because it has significantly less volatility. So when markets are bad, the volatility was 10%. The amount it dropped was 10% versus the all country world index dropped by about 13%. The TSX dropped by about 13.3%, and the S&P dropped by about 14%. And when you look at over time, whenever the market has dropped by 5% or more, you'll see the blue bars is the global equity fund, and the green bars is the MSCI All Country World Index. You'll see that except for the last period of 2020, it has dropped by less over every single time period. So protecting your downside when market is bad is very important. And the last one I want to talk about is the Tactical High Income Fund. This is the top fund in the tactical balance category. It's 50% equities and 50% bonds. So it's the best 10-year average for a balanced fund. It has a wide range of different investments, and you can see that over the last year, it did about 19%. Over the 3 year, it's 6.5%. The 5 year was about 10%, and the 10-year was about 9.5%. And you can see that it's beaten anywhere between 93% to 99% of its peers. So consistent track record is what I look at, and outperforming the market consistently over the long term is what I look at as well. And you can see that it's significantly outperformed against the category average. So now I just want to take a minute to talk about retirement and tax planning. And for most of you, because it's RRSP season, you're probably looking at where you should be investing. I'm going to go through some acronyms really quickly. RRSP is a registered retirement savings plan. A TFSA is a tax-free savings account. An RESP is a registered education savings plan. CESG is the grant you get when you put money into the RESP. A LIRA is like an RRSP, but it's locked in. FHSA, which is new in 2023, is a first-time home savings account. CPP is a Canada pension plan. OAS is old age security. This is what you get when you retire. GIC is a guaranteed investment certificate. An ETF is an exchange traded fund, which is basically buying an index. And then there's four main indexes. So the TSX composite index is the Canadian index. The S&P 500 is the US stock exchange or the US index. The MSCI EAFE is the index for the world, and the Russell 2000 index is the small companies global index. So the first thing I want to ask you is, do you actually know what taxes you have to pay on your assets and which assets are taxed and which ones are not? So we're going to go through this really quickly. There's only three things that do not get any tax. So the TFSA, the tax-free savings account, your principal residence, and your life insurance are the only three asset classes in Canada that don't have any taxation. Then we look at interest income. So interest income is taxed at your ordinary tax rate. So depending on how much money you make, your tax rate can vary from 20% to 52%. Capital gains. So anything that is non-registered has capital gains tax, and that's taxed at 50% on the first 250,000 and then 66.7% on anything above that. So where this really comes in is if you own a secondary property. So let's say you have a principal residence and you have a cottage. For example, if you sold your cottage and made $500,000 of capital gains, okay, so you made 500,000 on the sale of your cottage, the first 250,000 gets taxed at 50%. So that's 125,000 of tax. And the next 250,000 is going to be taxed at 66.67%. or 166,000 in taxes. So if you sold your cottage or your secondary property, an investment property, or any other non-registered investments, and you made 500,000, you would actually pay more than half, $291,000 in taxes, and you're only left with 208,000 net after tax. So on a $500,000 capital gain, you're only netting about $208,000. And similarly with dividends, eligible dividends are now getting grossed up to 38% tax, and non-eligible dividends get taxed at 15%. The one thing you do have to worry about is registered investments like RRSPs, RIFs, LIRAs, and LIFs. When you withdraw the money, you get fully taxed based on your income. Now, the one huge benefit to all four of these is when you invest it, you get a tax refund right away. So you're getting the time value of that money, plus you get compounded growth until you withdraw it. So there are huge benefits to registered investments, but when you do withdraw it, you do pay tax based on your marginal tax rate. So why do you need a retirement plan? We have the healthiest and longest living population in history. Over 1/3 of individuals between the ages of 55 and 65 will live beyond age 90. And the big challenge is there's been a lot of clawback on government payments. So Canada Pension Plan, the CPP, and OAS have been reduced. If you're in a high income bracket when you retire, you actually have a clawback on your old age security. And it's unlikely that those government benefits are going to continue, or if not, they're going to drop. Many of you who've been working for a long time would have a company pension that used to be a defined benefit pension, which was a guaranteed pension. Now most companies have moved to a defined contribution. So they match up to a certain percentage of your contribution in RRSPs. And the good thing with people who have financial plans, 76% of them say that they have less financial stress in retirement because of the plan. So what are some of the risks to your retirement plan? One of the biggest challenges most Canadians have is they're living longer and they don't have enough money for their retirement. We have this huge problem of inflation. 2 years ago, inflation was at 8%. We're now down closer to 2 or 3%. Rising healthcare costs. There's unpredictable fees for services. more and more there's been cuts on healthcare and healthcare funding. The big challenge for most people when they're retiring is if they have a bad year when they start. So when markets go down, if they start when markets go down, it can drastically impact their retirements. And on the contrary, if markets go up right before they retire, they'll have more money for retirement. And because we can't predict whether markets are going to go up or down, that's a huge risk. And we know that over the long-term care costs are increasing. The average cost of a senior's home now in Ontario is about $8,000 a month. And if one spouse dies, typically it has a huge financial impact on the remaining spouse. So some basic questions, things you should consider are: when do you expect to retire? How much wealth do you currently have? So how much assets do you have minus your liabilities or what you owe in your debt? Do you have a family history of longevity? Do you have good life expectancy? Do you have a family history of cancer, heart attack, or stroke? Are you planning on taking care of your parents, your spouse, your children, or your grandchildren in retirement? And if you are, how much money are you setting aside for that? And then what if you have health issues that you don't expect? If you have to go to a senior's home, how are you going to cover those costs? And then if you want to leave a legacy either to your family or to charity, how much money you're setting aside for that? There's very tax efficient ways to do that as well. So how much do you actually need for retirement? According to the BMO survey, Canadians need roughly 1.7 million in savings to retire, and that's up by about 300,000 from 1.4 million in 2020. Only 44% of Canadians are confident that they have enough money to retire as planned. 53% of Canadians report that they don't know how much money they need to retire. 22% of Canadians plan to retire between 60 to 69, with the average age of 62 years of age. 74% are concerned about how economic conditions will affect their financial situation. And 59% said economic conditions affected their confidence in meeting their retirement goals. So how much you actually need for retirement? It's assumed that you need 70% of your pre-retirement income to maintain your standard of living in retirement. So the average Canadian household over 65 spends about 60,000 a year. That means you need about 75,000 pre-tax to have 60,000 after tax. And if you take out the CPP and OAS, it gives you about $13,000 a year. So for a couple age 65, the average life expectancy for a male is 87, and for a female it's 89. So you have to plan for anywhere between 27 to 30 years in retirement. So the average retired Canadian will need 1.6 to 1.8 million in retirement income, but that's without factoring in any inflation. If you factor in inflation, that's closer to 2 million. So if you're 30 years old and you plan to retire by 65, you need to invest $17,736 per year to have 1.7 million in retirement, assuming a 5% average rate of return per year. So why should you invest in an RRSP? You can contribute up to 18% of your income and get a tax refund. So if you contribute before the March deadline, you get a refund in April of up to 48% of your income. And it's based on your previous year's income. So this year is based on 2024. And you can invest in a number of different investment options: mutual funds, ETFs, stocks, bonds, GICs. There's very flexible retirement options with an RRSP, and the money grows tax deferred with compounding interest. So every year that you contribute, you get a tax refund, plus the money continues to grow tax-free or compounded tax deferred until you withdraw it. And if you die, your RRSPs roll over to your spouse tax-free, but be careful, if the second spouse dies, then the money is fully taxable to your next of kin, so to your children. And the deadline is coming up soon. It's March 3rd. So if you haven't contributed, you should take a look at contributing. And to figure out your limit, just go to your notice of assessment on your CRA. So why should you invest in RRSPs? It helps you invest. It helps you maintain your standard of living. It helps you ensure you have enough for retirement. The money grows tax deferred until you withdraw it. At retirement, your income is probably going to be lower than it currently is, so you're going to pay less taxes when you draw it, which means a smaller percentage of your income will go to taxes. There's also two other options. If you're a first-time home buyer, you can draw up to $35,000 from your RSP tax-free. And that if you and your spouse are both doing that, that's up to $70,000, but you have to repay it over 15 years. And if you're planning on doing post-secondary education, you can withdraw up to $20,000 for education or tuition, $10,000 per year, but that also has to be repaid within 10 years. So why is an RRSP such a great option? If you contribute the maximum amounts, if you make $100,000 income and you contribute 18,000, you're gonna get a tax refund of $6,500. If you make $80,000 and you contribute 14,000, you're gonna get a tax refund of 4,000. If you're an income of $60,000 and you contribute 10,000, you're gonna get a refund of 3,200, which is 32%. And even if you make 40,000, you can contribute up to 7,000. You're still gonna get about 1/3 back, about $1,444. So it does make sense to take advantage of this. It's good to maximize your RSP contribution. Then you take the tax refund and put it into a TFSA, and you're going to get tax-free growth on that as well. So I'm going to give you an example. Sarah is 30 years old and makes $100,000 a year. She wants to retire at 65, and she's wondering if she should invest in an RSP. If we assume that she needs 75% of her income in retirement and she contributes $18,000, which is the maximum RSP contribution every year for the next 35 years, even with only a 6% rate of return before retirement each year and a 4% rate of return after retirement, she's going to have over $2 million at age 65, and she's going to have enough money until her life expectancy. She'll have 235,000 left over at age 90. So it does make sense to take advantage of the RSP and maximize the contribution. Now, a lot of people always ask me, well, I don't have money in the bank. Should I borrow the money to contribute to an RSP, or should I pay down my debt? So let's take an example. If you get a line of credit for $10,000 at a 5% rate of interest, the interest cost is going to be $500. If you take that 10,000 and you invest it into your RSP, you're going to get an immediate tax refund of roughly 30%. So on $10,000 contribution, you'll get about 30% back, about $2,965 in April, and you can take that money and pay it down against your debt, and that'll reduce your debt. Okay? And so that money that you're putting in the RSP is also going to continue to grow tax deferred with compounded interest. So we get the time value of money and the growth on that. If you actually decide to pay down your debt instead of borrowing the money to put into an RSP, you're only saving about, at a 5% rate, $500. Versus in the RSP, you're getting about $3,000 back. So which would you rather prefer? Paying down your debt and saving $500, or getting $3,000 to $4,000 every year? It obviously makes sense to take out a loan and invest in the RSP as long as you pay back that loan. So there's also something called the spousal RSP. So if you make significantly more money than your spouse, you can contribute to a spousal RSP. So the person in the higher income bracket contributes, and so they get a tax break on their higher income, but the money goes into the spouse's account. So if the spouse is at a lower income and she withdraws it or he withdraws it, they end up paying less tax on it. Okay, so the good benefit there is the person who's in the higher income bracket gets a tax break. The person in the lower income bracket, when they withdraw it, they pay the taxes. They'll end up paying less tax. The only challenge is that this money now belongs to the spouse. So if there is in the event of divorce or separation, the spouse now owns that money even though it was contributed by their partner. So when you withdraw from an RSP, you can do it at any time, but it's taxable when you withdraw it. So the two best time to withdraw from an RSP are when you're a low income bracket or if you lose your job. You shouldn't be withdrawing your RSP for ordinary living expenses and those sort of things. At age 71, you have to convert your RRSP to what's called a RIF, a Registered Retirement Income Fund, and all it means is that you have to start drawing the money by age 72. So how do you fund your RSP? Like I mentioned before, regular contributions are better than waiting for the deadline. If you do a monthly contribution, do dollar cost averaging, it allows your money to grow tax-free for longer and avoids the market fluctuations. Also, an investment loan is a good idea. If you're in a high income bracket, it's good to take a loan and get the tax refund. And if you can't contribute the maximum amount, it's okay. The money rolls forward for future years and is carried forward indefinitely. So your contribution room continues to grow. So what is a TFSA? A tax-free savings account is something where you can contribute up to $7,000 a year to a maximum, including this year, of $102,000. It's for any Canadian resident over 18 years old. The challenge is you can only put in $7,000 a year to a maximum of $100,000. You don't pay any tax on any of the money, but it's on after-tax dollars. So you're not actually getting a tax break. All you're getting is tax-free growth on that money. This is good for people who are seniors who are worried about OAS clawbacks on their government benefits. They can withdraw the money tax-free and you can actually recontribute it in the following year, but it can't be put back in the same year. So when should you be investing in an RRSP? If you're in a higher income bracket, it's better to invest in the RRSP first. The TFSA is limited on the amount you can contribute, whereas the RSP you can put up to 18% of your income plus any unused contribution room. In most cases, the best option is to put money in your RSPs first, get the tax refund, and then reinvest the refund into your TFSA. So let's use the example of Sarah. She's 30 years old and she makes $100,000 a year. She wants to know if an RSP or TFSA is better for her. If her taxable income is 100,000 and when she withdraws the money, she's going to make 75,000 a year. She puts in 18,000 a year every year and she invests the RSP refund. So when she gets the refund, she's going to reinvest it. And we're assuming she's 30 years old, so she's going to contribute for the next 35 years till 65. Even at a 6% rate of return, she ends up better with an RSP than a TFSA. Because you'll see here that in an RRSP on the right-hand side, when you contributed 18,000, you don't pay any tax. It reduces your taxable income. Versus in a TFSA, if you put in 18,000, you have to pay the tax. So you end up being behind the game because TFSA is after tax dollars. It doesn't give you any tax refund. So when should you put in a TFSA over an RSP? If your income is low now and you expect it to stay that way, or you expect it to increase in the future, if you're over 70 years old, if you expect your income to be higher in retirement, if you have a large pension plan, if you don't have any income, so you're not actually declaring any income, then TFSA is the only option. And if you need the funds in the near future, aside from first-time home buyer or post-secondary education, then TFSA is a better option. So for those of you looking to buy a house, a first-time home savings account is the best option because you can contribute $8,000 a year tax-free to a maximum of $40,000. It's available to anybody over the age of 18. And just like an RSP, you get a tax refund and the money continues to grow tax deferred. The FHSA can also be used with the TFSA and the RSP homebuyer plan. So if you have planning on purchasing a home, you can put in 40,000 into the FHSA and 35,000 into the homebuyer plan. And unlike the RSP homebuyer plan, you don't have to repay the money that you withdraw. Okay, so the key thing here is that you can only have the account for up to 15 years. If there's anything left over, you can roll the money into your RRSP on a tax-free basis, but when you draw it from your RRSP, you will be taxed. And you can carry forward up to $8,000 of your unused contribution. And last but not least, an RESP is the best option if you have a child. The government gives you $500 every year per child on each $2,500 of contribution. You can contribute up to $5,000 per child, and the government will add a 20% grant for each calendar year up to the 18th birthday. And the maximum amount you can contribute is $50,000 per child. And if you haven't contributed the previous year, you can roll forward the $2,500 contribution room So if you didn't contribute last year, you can put in 5,000 and the government will give you 1,000. You don't get any tax deductions for the money you put in, but the money grows on a tax deferred basis while it's in the plan. And when you take it out for any education related expenses, it gets taxed to the child. So if the child is a student, they're in a zero income bracket, they're not going to pay any tax on it. When the funds are withdrawn, it's applied to the investment income and the government grants are received, not on the contributions you made using your funds. The amounts are taxed in the hand of the student, not the contributor. Any relative can contribute, so a parent, a sibling, or a grandparent can make the contributions. And if there's any unused contribution room, it can be transferred to the subscriber or to the RRSP. So for example, if I contribute for my daughter and she doesn't go to university, I can transfer it back to my RRSP as long as there's RSP contribution room, but I don't get the grant portion back in my RSP. And the good part is if you have more than one child, you can contribute to a family RESP plan where you can allocate whichever amount of the money to either child. So it's 7:30 on the dot. That's it for me. This is my contact information. I would be happy to sit with any of you and book a complimentary financial plan for you. Feel free to click on this link to book a Calendly meeting in my calendar. And with that, I'm going to open it up to any questions. Okay, well, thank you for your time. I appreciate you spending the hour with me, and I look forward to hearing from any of you. If you'd like to book a meeting, feel free to call me, email me, or book a meeting in my calendar. Please make sure you take advantage of the RSP contributions before the deadline of March 3rd. And here's the legal disclaimers that I have to show you. And that's everything. Thank you so much.